Not as loud as the US, not as aggressive as China, yet Canada is quietly building a multi-hundred-billion-dollar electric vehicle battery empire. How is this nation positioned to overtake Detroit and become North America's EV battery hub? Canada is rapidly emerging as a global EV battery production center, with total investments now exceeding $174 billion, surpassing even Detroit, the traditional heart of the American auto industry. Volkswagen is building a massive gigafactory in Ontario with a production capacity of 90 gigawatt-hours per year, enough to power 1 million EVs. The total investment? Around $14.8 billion, with 13 billion Canadian dollars coming from the Canadian government. Stellantis and LG Energy Solution are investing over 5 billion Canadian dollars in a facility in Windsor, expected to create 2,500 jobs. Northvolt is constructing a 7 billion Canadian dollars plant in Quebec with a 60 GWh per year capacity and 3,000 new jobs. These mega projects are generating thousands of high-tech jobs in Ontario and Quebec, giving locals access to advanced manufacturing and R&D careers and reducing dependence on traditional industries. But Canada isn't just assembling batteries, it's mining critical minerals like lithium and cobalt and investing in refining and recycling. For example, Recyclico has developed recycling technology capable of recovering up to 98% of battery metals. This integrated approach is helping Canada establish a full clean energy career pipeline spanning raw materials to high-end manufacturing while stimulating regional economic growth. Canada holds free trade agreements with major economies, including the US and Mexico via USMCA, the European Union through CETA, the United Kingdom, Japan, South Korea, and CPTPP countries like Australia and Vietnam. Thanks to these agreements and generous government investment incentives, major automakers like Ford, GM, Volkswagen, and Stellantis have shifted EV battery and component production to Canada. This strategic move allows them to qualify for U.S. tax breaks under the Inflation Reduction Act, IRA, while ensuring stable North American supply chains. Canada is taking on a central role in North America's EV battery supply chain, with production capacity to support over 2 million electric vehicles annually. Meanwhile, the U.S. is struggling to secure key minerals like lithium and nickel, making it increasingly reliant on partners like Canada. The U.S. Inflation Reduction Act encourages the use of battery materials from FTA countries, placing Canada in a highly favorable position. As China continues to dominate global lithium-ion battery production, accounting for roughly 77% of capacity, Canada is working to build a more secure and independent EV supply chain. To reduce reliance on Chinese imports, Canada has joined international initiatives like the Minerals Security Partnership, alongside the US, EU, Japan, and South Korea. Canada is also investing in alternative technologies, including cobalt-free batteries and advanced recycling. Companies like Recyclico are leading the charge, with innovative processes that recover up to 98% of metals from used batteries, critical for sustainability and long-term cost control. Intense negotiations between the U.S. and China in Geneva have concluded with a framework agreement aimed at temporarily easing the trade war, yet, with gold prices hitting record highs and American businesses continuing to warn of policy risks, the question remains, is this truly a victory for the U.S. economy? On May 12, 2025, after 2 days of negotiations in Geneva, the U.S. and China reached a temporary agreement to reduce tariffs for a 90-day period. Under the deal, the U.S. lowered tariffs on Chinese goods from 145% to 30%. China reduced its tariffs on U.S. goods from 125% to 10%. The tariff reductions are expected to ease price pressures on imported goods, especially in sectors like toys, apparel, and electronics. However, the 30% U.S. tariff remains significantly higher than previous levels and may continue to affect consumer prices and product choices. The agreement includes a phased tariff reduction mechanism contingent on China fulfilling commitments to open its markets and end currency manipulation. However, prominent U.S. business leaders, including Warren Buffett and Jamie Dimon, have voiced concerns. High tariff levels are hurting domestic companies, and there's a lack of transparency in trade policy. The uncertainty surrounding trade policies could lead to price volatility and weakened consumer confidence. As a result, American consumers may continue to face unstable prices and limited product choices, at least in the near term. President Trump signed an executive order aimed at maximizing the extraction of minerals, timber, and seafood in Alaska. The move boosted shares of gold mining companies like U.S. Gold Mining Inc., USGO, with gold prices soaring to a historic high of $3,400 per ounce in early May 2025. Rising gold prices may increase production costs in industries that rely on gold, such as electronics and jewelry, potentially leading to higher prices for consumers. While the temporary U.S.-China trade agreement has eased tensions and provided short-term benefits for American businesses and consumers, the core issues in bilateral trade relations remain unresolved. U.S. consumers should be prepared for further policy shifts and market volatility ahead.
The ongoing U.S.-China trade war is escalating, with bold moves from both sides. China is preparing strong measures, ranging from tariffs to financial strategies, in an effort to reverse the tide of the conflict. But will these actions be enough? The trade war between the U.S. and China intensified further, as U.S. President Donald Trump announced an increase in tariffs on Chinese imports to 145%. This new tariff includes 125% retaliatory tariffs and an additional 20% surcharge that was applied earlier. In response, China announced a 125% tariff on U.S. goods. However, the Chinese government stated that it would not back down or continue participating in the tariff escalation. China explained that the current tariff levels have already surpassed what is acceptable and have negatively impacted bilateral trade. It emphasized that further tariff increases would not improve the situation, but would only make trade relations between the two nations more unrealistic. China is now looking to shift towards diplomatic measures and dialogue, but insists that the terms of the trade agreement need to change in order to reach a long-lasting and fair resolution. Chinese President Xi Jinping spoke out about the trade war with the U.S., asserting that China would not succumb to suppression and would not make concessions in this confrontation. His statement came shortly after the U.S. imposed tariffs on Chinese goods and threatened to escalate its retaliatory measures. President Xi emphasized that China has developed independently for over 70 years and does not need help or preferential treatment from any other nation. He firmly stated that China would not yield to external pressure, reinforcing that the country will maintain its stance and continue to develop in its own way, unaffected by outside measures. U.S. President Donald Trump has also expressed his willingness to work with China to find a solution to the trade dispute. However, with China's firm stance, achieving a resolution may prove to be even more challenging. Simultaneously, China issued a travel advisory for its citizens traveling to the U.S. The advisory urges Chinese nationals to carefully assess the risks before planning trips to the U.S. and encourages cautious travel. This not only affects tourists, but also impacts Chinese students studying in the U.S. The warning could lead to a reduction in the number of Chinese visitors to the U.S., which would significantly affect the tourism industry and trade activities between the two countries. China currently holds approximately $760 billion in U.S. Treasury bonds, making it one of the largest creditors of the United States. This provides China with a powerful tool to pressure the U.S. economy should it choose to sell off these bonds. While this is a double-edged sword, as selling U.S. debt would also have negative consequences for China, it could still be used as strategic leverage in the trade war. However, China is fully aware that such a move could pose significant risks to its own economy, and thus, it will carefully consider this action before proceeding. The outcome of this escalating trade conflict remains uncertain, but China's firm responses and strategic preparations indicate a determination to stand its ground in the face of increasing pressure from the United States. Financial markets are rattled as the U.S.-China trade conflict enters an unprecedented phase. Interest rates are climbing, and the U.S. dollar is losing ground. What lies ahead for the American economy? As of April 11th, U.S. financial markets have experienced notable declines. The S&P 500 has dropped 8.8% since the start of the year, while the Nasdaq Composite has fallen 13.4%. The Dow Jones Industrial Average is also down 5.5%. Alongside equities, the yield on 10-year U.S. Treasury bonds has climbed to 4.5%, reflecting concerns over inflation and potential future interest rate hikes. The U.S. dollar has weakened, particularly against the euro and the Japanese yen. In contrast, gold prices have increased as investors shift to safer assets in response to currency depreciation and ongoing market instability. Over the past week, President Donald Trump announced a significant increase in tariffs on Chinese goods, bringing the total rate to 145%. This includes a 10% base tariff, a 125% reciprocal tariff, and an additional 20% aimed at addressing fentanyl-related issues. These measures are intended to encourage domestic manufacturing and reduce reliance on foreign supply chains, especially in critical sectors such as semiconductors and pharmaceuticals. China responded by raising tariffs on U.S. imports to 125% and stated it would not escalate further, regardless of future American actions. Additionally, China has imposed restrictions on the export of key resources like rare earth minerals, impacting U.S. defense and high-tech industries. These developments have contributed to global market fluctuations, with record gold prices, rising bond yields, and a continued weakening of the dollar. Across Europe, several countries are actively exploring deeper economic ties with China. Recent talks and agreements between the European Union and Beijing underscore a growing shift in international trade dynamics. One prominent area of cooperation is the electric vehicle sector. The EU and China are discussing the implementation of a minimum pricing mechanism for Chinese EVs imported into Europe, which could replace the current high tariff structure. Previously, the EU imposed tariffs of up to 35.3% due to concerns about state subsidies, but the ongoing negotiations aim for a more balanced and sustainable solution. Beyond EVs, discussions are also advancing in renewable energy and clean technology. During a recent visit to Beijing, Spanish Prime Minister Pedro Sánchez highlighted the importance of strengthening bilateral trade and investment in these emerging sectors. President Trump came under scrutiny last week following a social media post made on April 9th via Truth Social, in which he stated, "Now is a great time to buy," alongside the stock symbol DJT, referring to Trump Media and Technology Group. Just hours later, the administration announced a partial delay in retaliatory tariffs, maintaining a 10% base tariff on most trading partners. The timing of the post prompted concern from several Democratic senators, including Chuck Schumer and Elizabeth Warren, who have called on the SEC to examine whether the post may have provided an unfair advantage to those close to the president. On April 9th, DJT shares surged by 21.67%. Additionally, a video shared by White House communications aide Margot Martin appeared to show President Trump suggesting that some of his associates had benefited significantly from the market activity, raising further questions about potential misuse of privileged information. According to data from Freddie Mac, the average 30-year mortgage rate in the U.S. has fallen to 6.62%, marking the third consecutive week of decline. Despite this, broader economic sentiment remains fragile. The University of Michigan's Consumer Sentiment Index dropped to 50.8 in April, down from 57.0 in March, reaching its lowest point since 1981. At the same time, short-term inflation expectations rose to 6.7%, reflecting growing concerns over rising living costs and economic uncertainty. Major financial institutions, including Goldman Sachs, have revised their outlook, raising the probability of a U.S. recession in 2025 to 35%. These projections are driven by the combined impact of trade policy uncertainty and continued market volatility. EU diversifies partners, looks to internal market to counter potential 144 billion euros loss. Could these strategies safeguard Europe's supply chains and global standing against pressure from Washington? In 2023, the European Union was the world's largest trading power, accounting for 16.1% of global trade, valued at 7.6 trillion euros, according to Eurostat 2024. The U.S. remains the EU's largest trade partner, representing 17% of EU trade, equating to 1.6 trillion euros. However, this trade relationship lacks any free trade agreement, FTA, protection. Under former President Donald Trump, the U.S. imposed tariffs of up to 25% on imported cars from the EU and 10% across the board. Alarmingly, Trump's trade advisors are suggesting a return of a 20% tariff on all EU goods within the first 3 months if he re-enters the White House, according to Bloomberg. According to the European Commission, a retaliatory tariff war at 25% could reduce EU exports to the US by 17.5%, causing a direct loss of 0.54% of the EU's GDP, which is equivalent to 144 billion euros, according to a European Commission trade impact study. US consumers would face sharp price increases on imported goods from Europe, including cars, wine, and industrial equipment. The Brookings Institution predicts core inflation could rise by an additional 0.3 percentage points if these tariffs are reinstated, according to Brookings. To reduce dependency on the US, the EU is accelerating FTA negotiations with emerging economies. India is a top priority. If an FTA is concluded, the import tariff on cars could drop from over 100% to just 10%, according to Reuters. Bilateral trade between the EU and India is projected to reach 167 billion euros by 2026, with EU exports totaling 75 billion euros and imports from India reaching 93 billion euros. Additionally, a deal with Mercosur, Brazil, Argentina, Paraguay, and Uruguay could boost total trade to 126 billion euros, with the EU exporting 77 billion euros and importing 49 billion euros. For Mexico, improving market access alone could increase EU exports by 20%, or 10 billion euros. In total, if all 3 FTAs are approved before 2026, the EU could recover around 91 billion euros, though it would still fall 53 billion euros short of the losses from the US. Alongside expanding partnerships, the European Commission is calling for improvements to the EU's single market, established in 1993. While barriers to goods have been removed, 3 key pillars, services, capital, and labor, still face significant hurdles due to national laws. For example, Polish plumbers must recertify to practice in Belgium. Startups in Portugal struggle to raise funds from the Netherlands due to differing investment laws. And EU citizens face bureaucratic obstacles when working in other member states. According to a new study by the European Parliament, this lack of integration costs the EU 1.1 trillion euros annually, 279 billion euros from services, 415 billion euros from the digital market, 300 billion euros from goods, and 50 billion euros from public procurement, according to European Parliament policy study. If reforms are implemented, the EU could fully recover the 144 billion euros loss from US tariffs, while also boosting its internal competitiveness. Car prices are rising, jobs are gradually disappearing, and Americans are struggling in the midst of a shifting economic landscape. What is happening to the auto industry, once the pride of the United States? Tariffs and protectionist trade policies have driven production costs sharply higher, pushing the price of American-made vehicles to record levels. According to Edmunds, by early 2025, the average price of a new car has surpassed $50,000 USD, while used vehicles are nearing $32,000 USD. With incomes failing to keep pace, many consumers are left with no choice but to hold on to older cars, even as maintenance costs continue to rise. Cox Automotive reports that a standard oil change, once around $50 USD, now exceeds $100 USD. Hourly wage earners and those on fixed incomes are bearing the brunt of this burden, particularly as broader living costs, from groceries to gasoline, rise in tandem with the new wave of tariffs. McKinsey notes that 75% of American consumers have shifted to buying cheaper goods, primarily food, due to tightening household budgets. At the same time, unemployment is spreading. The manufacturing sector is seeing a jobless rate of 5.2%. Construction has shed 34,000 jobs, and agriculture has experienced a 3.8% reduction in its workforce. These losses stem from rising raw material costs, declining export demand, and widespread order cancellations, all of which are forcing families to cut back on spending, weakening purchasing power across the broader economy. As American car prices rise and deliveries slow due to parts shortages, Japanese and Korean automakers are gaining ground, thanks to competitive pricing and more agile supply chains. In 2024, Toyota captured 12.5% of the US market. Hyundai Kia held 10.2%, and Honda accounted for 8.1%. These vehicles are known for their durability and fuel efficiency, qualities especially valued amid the steep increase in fuel prices driven by new import tariffs. Hyundai has announced plans to invest 21 billion USD by 2028 to build electric vehicle and steel manufacturing facilities, expected to create an additional 100,000 jobs and stimulate regional economies. In contrast, many American automakers have been forced to scale back production due to rising costs, leading to widespread layoffs. This has reduced consumer access to domestic models, while further pushing up the price of American-made cars. The shift toward Japanese and Korean vehicles also reflects a broader trend, a trend toward more frugal consumer behavior. With U.S. economic growth projected to slow to 1.4% in 2025, down from 2.2% previously, according to McKinsey, many Americans are adjusting their spending habits in anticipation of leaner times. The 25% import tariff has driven up car prices by an average of 13.5%, or roughly $6,400 USD per new vehicle. This price spike not only strains consumers, but also directly affects manufacturing and exports. Ford has halted exports of the F-150, Mustang, and Bronco to China in response to retaliatory tariffs of 150%. Stellantis has laid off 900 workers across 5 plants, while Volvo has announced job cuts ranging from 550 to 800 positions. Current trade policies are weakening the U.S. auto industry, leading to declining revenues, job losses, and reduced access to domestic vehicles for American consumers. Without timely adjustments, U.S. market share for American-made cars could fall below 40% within the next 5 years. The inflationary pressure driven by tariffs is also spreading to other sectors. In agriculture, the unemployment rate surged to 12% in March 2025, the highest in years. This reflects the broader, cascading impacts on the overall economy and the daily lives of millions of Americans. Case IH, a $34.5 billion. Agricultural equipment giant withdraws from the U.S. Over 3,000 American workers lose their jobs. Towns reel and farmers face part shortages mid-season. Following Case IH's exit, could this shock mark the beginning of a global restructuring wave pulling out of the United States? In early April 2025, Case IH, the tractor and agricultural machinery brand under CNH Industrial, unexpectedly issued an internal memo announcing the closure of all its manufacturing facilities in the United States. This includes the main assembly plant in Racine, Wisconsin, and the engine production center in Fargo, North Dakota. According to CNH Industrial, the decision is part of a global strategic restructuring, shifting operations to Brazil, Germany, and India to leverage lower labor costs and tariff incentives. Case IH's withdrawal immediately resulted in over 3,200 American workers losing their jobs. The move delivers a significant blow to the $34.5 billion U.S. agricultural machinery industry, already under strain from global competition and rising material costs. Post-pandemic, the National Farmers Union warned Case IH's exit puts 1 in 4 large farms in the Midwest at risk of operational disruption due to a lack of timely replacement parts. Beyond the direct layoffs, thousands of indirect jobs across the supply chain, from forges and transport firms to control software companies, are also at risk of being wiped out. In Racine, Wisconsin, where the Case IH plant had operated since 1969, over 1,800 workers were laid off. The town, once reliant on agricultural equipment manufacturing, now faces widespread economic collapse. According to the local planning department, unemployment in Racine surged from 4.3% to 11.7% within just 2 weeks of Case IH's announcement. Businesses surrounding the industrial zone reported revenue drops of 50–70%. A local bank noted 30 mortgage delinquencies in less than 10 days. In Fargo, public schools were forced to merge 12 classes and lay off 14 teachers as families began relocating. Mike Thompson, 52, an assembly line worker, told Reuters, "My dad worked here, and so did I. Now I've lost my job, and my daughter can't continue college because she lost her scholarship from the company." The Red Racers youth team, sponsored by Case IH for 15 years, had to disband due to lack of funding. Many families have moved to other states for work, creating housing and social service crises in their new communities. Case IH's shutdown has paralyzed the U.S. parts distribution system. Sensors now take up to 6 weeks to arrive. Hydraulic hoses are nearly impossible to source. Farmers in Iowa and Illinois report equipment breakdowns they can't repair. Warranty requests are piling up. Some are resorting to 3D printing parts or switching to John Deere and Kubota machines, which now offer discounts and fast delivery. Dealerships and technicians are also severely affected. Over 400 authorized service centers face potential closure or mergers. Trust in Case IH has crumbled. Many farmers accuse the company of concealing its exit plans since 2023. Used Case IH tractors are now being sold off at 30–50% below market value. At agricultural fairs, Case IH's signature red color has all but disappeared, replaced by competitors handing out free merchandise to attract new customers. Vocational schools have stopped teaching. Case IH repair courses and the company's scholarships have vanished. Meanwhile, local agricultural startups are rising with a farmer's first philosophy, offering a glimmer of hope for the industry. The United States has ignited a new trade war with China, creating a seismic shift that has prompted the European Union and Canada to reassess their positions. A global realignment of trade flows is now underway. The question remains, who will ultimately hold the balance of power? At the beginning of 2025, the Trump administration officially restarted the trade war with China, focusing on key sectors such as electronics, steel, aluminum, chemicals, and high-tech components. On April 6, 2025, the United States announced additional tariffs ranging from 34% to 50% on over 600 categories of goods, with cumulative tariff rates potentially reaching up to 104%, according to Reuters. The objective is to reduce the U.S. trade deficit with China, which stood at USD 383 billion in 2024 U.S. Census Bureau. However, according to the Consumer Technology Association, the prices of laptops and smartphones in the United States rose by 7 to 12% in April 2025 alone. Bloomberg Economics projects that consumer inflation could increase by an additional 0.3 to 0.5% points in the second quarter of 2025. Essential goods